and welcome to today's presentation, which is called S&P 500 October Crash. After listening to the full video, you will be pretty clear what I think about that proposition. So, let's move into the opening part of the week. Remember that daily analysis on my site are the basis, so make sure that you are subscribed or following them at least via Twitter when I announce them, with a little delay that they are published. Telegram, you get the notifications immediately, so consider utilizing all of the three that I'm offering to you. So let's move into the big picture as regards stocks and the real economy. Starting with Friday recap, we saw the unannounced, unscheduled Bank of Japan bond buying initiative, which injected fresh liquidity, and the core PCE coming slightly below expectations means that some renewed fresh pivot hopes were rekindled, and the rally that ensued and was maintained, because this whole upswing started pre-market, unfortunately fizzled out way too early, already on the third case and decline rejection at 4365. So that means that the bears under the surface are still quite strong. That's a working hypothesis that we will check together in the upcoming charts. We had also seen yields decline slightly, that famed for 70 percentage points on the 10-year that I told you about on Twitter, but in my view the top isn't yet in, and it would take easily for 90, depending on how well the real economy keeps holding up on the 10-year before the top in yields in this not just credit but business cycle is in. When it comes to quarter end positioning and chasing better fourth quarter results, we are likely to see this play out gradually over the weeks ahead in the stock market. Note that this does not preclude and actually confirms still kind of a rocky October. When it comes to the shutdown speculations and whether there is one or not in the end, it would have a relatively muted effect upon the stock market. Base case is that it would be somehow avoided, and if it is entered into, it would not too dramatically all by itself sink stocks. No, it would be relatively muted, not much of an upside on the relief, and not dramatically amplify the downside when it starts early next week. The bigger theme is sticky inflation, and the market realization about it being actually sticky is still ahead. And then it's not a function of rising oil prices seeping into pretty much everything else. This is about continued wage pressures and labor scarcity. And I'm afraid that the core and supercore inflation metrics would remain stubborn and very far from the Fed's 2% objective. And if you remember my criticism following FOMC of the self-contradictory Fed projections for GDP acceleration, inflation coming down, and job market being more resilient than it had been earlier forecasted, this kind of excludes itself And the key point that I'm hammering is that it takes a recession, a genuine recession, which we would enter into in the first half of 2024 to bring down inflation. And yet the core and supercore, that's the services one, minus, meaning excluding housing, that would still prove resilient even if we are in a recession, because that would mean more of a demand destruction when it comes to oil and oil consumption. But for now and for the months ahead, there is no such problem. So oil prices can and will go on appreciating. That's when the genuine stock market decline would arrive, only on dramatically deteriorating data, sealing the fate over the no landing versus recession debate. We see it already in the yield curve, which is very slowly, but it can be visible over the, say, past 2 months. It's slowly normalizing, and the still negative time premium, meaning your reward if you want to go out on the yield curve and stay in, say, longer than 10-year maturities as opposed to rolling over short-term bills, that time premium is going to be slightly increasing. It's a process, and when the yield curve flips positive, is no longer inverted, it's usually when the recession is being entered into. As for more details about the FOMC contradictions than I have covered right now for you as a great reminder of what it means for the economy and asset prices, risk-taking in general, please see prior Thursday's Great Asset Repricing article. So let's move into the finally into the daily charts for the S&P 500. We see Friday quite a fine reversal to the downside. Volume was higher, there is some lower knot, so it's not yet totally conclusive in the way that one could say that Monday would be 100% down, 100% certainly a down day. For 340 must better hold, because it gives the bulls skin in the game, some lasting power. For 365 is what would signify that the buyers have higher staying power than just 1 day. So beware of this key level being jeopardized. For 315 break on a closing basis tips the scales quite decisively in the bear's favor, clearing up the way to 4285 and then 4260, which could be reasonably first point in time when you could consider it to be a bottom in this correction. More probably, though, I'm aiming for good 2000 points lower. Now I will start discussing this point somewhat more over time. Just give me a clue that you are interested in it, and mention even individual stocks that you want me to analyze for you. It would be the sectoral view and the very short-term game plan. We had seen financials declining almost full percentage point Friday. That's not really a strong cyclical showing. which is though balanced out by discretionaries driven by Tesla doing quite well. And the deciding factor Monday, Tuesday would be tax sensitivity to yields, whether if yields move down, meaning if they retreat, what's the magnitude of tech upswing? Is it multiplied or not? Similarly, if yields only remain on their current level or start rising again, what would tech do? Start sinking the way gold does, or not really? These would be valuable clues allowing for determination of what's the bottom. Also look at how materials and energy would be doing. You want them to do well if you are a buyer. At the same time, US dollar and liquidity are likely to keep playing longer term negative bearish effect. Finally, one more chart about market breadth. You see it's quite weak, and the percentage of stocks trading above their 50-day moving average, if it goes back above 25%, then the bears should start getting worried. But for now, I don't see any change in the dynamic of the overwhelming majority of the S&P 500, meaning everything else apart from the magnificent 7, to turn around and start clocking in dramatic gains. That's the dynamic that I see playing out only later in the fourth quarter, but not really in October yet. So these are the big picture views. Thank you for liking, subscribing and commenting